Good day. My name is Ed McFerran. I'm House Counsel for Tax Deferred Exchange Services. We're a national qualified intermediary company. We're headquartered out of Tacoma, Western Washington, and we provide services for clients throughout the United States, Alaska, Hawaii, and even the Virgin Islands. Our topic of discussion today is one where we're going to discuss what's called reverse tax deferred exchanges. This particular topic is of tremendous interest to many of our clients, but we often say that this is an area of practice where many are called, but few are chosen. And so if you're interested in completing a reverse exchange, please contact our people because this area of practice requires some very specific issues to be addressed. I'm going to talk about this area by attempting to use examples because I think examples can better portray how a reverse exchange can work for you. But I can tell you today that sophisticated investors today do not like what we call forward delayed tax deferred exchanges. Why? Well, one of the reasons, of course, is that it's constraining from a time standpoint. You have 45 days to declare the property and an additional 135 days to buy the property. And in many market areas around the country, those types of time constraints are almost producing failure for many parties who's completing tax deferred exchanges. Many investors are looking for a strategy that allows them to acquire a replacement property in a fashion prior to the actual closing of the relinquished property. Let's use an example. I had a lady in our office in Tacoma who was wanting to complete a tax deferred exchange. It was a very vanilla property. It was a single family residence that she had actually lived in many years previous, but many years afterwards had moved out and had rented the property for about 15 years. It had no debt on her property, and the property had appreciated significantly over the years and was worth, at the present time, about $750,000. The marketplace in her location was robust, and the broker who came along with her to the consultation indicated that he said it would take 2 to 3 days for her to sell the property with a full price offer and people waiting in the wings. The difficulty is that she wanted to buy a replacement property that would allow her daughter and son-in-law to live in the replacement property. In this case, it was a duplex. They were going to live in half of the duplex, and she was going to rent out the other half of the duplex property. Was this an appropriate transaction? The answer is definitely yes. It's not a related party transaction. You may have heard the term related party transaction. It's not related because she's not buying from her son or daughter-in-law or son-in-law. She's not selling to them. She's merely renting to them, and there's no preclusion upon renting to family members in a tax deferred exchange. The difficulty is that the place that they were looking for duplexes was one of the hottest marketplaces in the state, and as they were looking for duplexes, they were coming on the market and being swept up for sale almost immediately. She was frustrated in the consultation because she had a fear of failure. She was convinced that she would be unable to complete a tax deferred exchange. Her property will have sold promptly. The money would be in the exchange account. She wouldn't be able to find within the 45 days a suitable replacement property. And as a result, after an awful lot of work and effort and frustration, she would end up paying the capital gains tax on the sale of her investment property, which would be a huge burden for her to pay. As we were talking about this, I asked her a few questions. The first thing I did know is that she had no debt on the relinquished property. And I asked her generally what her financial situation was, and she had high credit scores. She had some investments. She certainly wasn't a huge investment player, but she was suitable from the standpoint of being financially qualified. I suggested to her the possibility of completing a reverse exchange, to which she obviously had no clue what a reverse exchange was. But in essence, a reverse exchange is one where we take on a new job. We call ourselves qualified exchange title holders. What that means is that we're going to acquire a property and we're going to hold the property and own the property, generally by setting up a separate limited liability company, and that property is going to be owned and operated by us until we can convey the property to the exchanger as the replacement property in a normal tax-deferred exchange forward exchange. With every reverse exchange, you will always have a forward exchange, but you'll not necessarily have a reverse exchange with every forward exchange. So a forward exchange, as you probably know, is one where the relinquished property is conveyed to a third-party purchaser, and afterwards, within 180 days, the replacement property is acquired by the exchanger through the help of the qualified intermediary. In a reverse exchange, the qualified exchange title holder, another job for us, acquires the replacement property prior in time to the conveyance of the relinquished property, and we hold that property, we call it parking the property, and operate the property until the relinquished property closes. Here's what we did. In our particular transaction, we had a client that had some financial acumen, and we had a friendly banker in our town that was willing to lend to the client based upon pledging the collateral of the single-family residence as well as the collateral of the property that we were going to acquire. Interestingly enough, the property that we were going to acquire was in a very hot marketplace, and duplexes in that marketplace were anywhere from $1.4 million to $1,600,000. In essence, we acquired the duplex through the tax-deferred exchange, qualified exchange title holder process, again, a reverse exchange, and we acquired through the help of the banker lending us, with a guarantee from our client, the money necessary to acquire the duplex replacement property. What did we pledge? Well, we pledged the duplex. What did the client pledge? The client pledged her investment property, and she also guaranteed the loan. The banker felt comfortable and qualified, and immediately upon the closing of the duplex property, which was the to-die-for property for the client, she listed the property for sale with her real estate professional, and as indicated, within 2 or 3 days afterwards, had a full price offer. That transaction took about a month to close, and at the end of that transaction, we had $750,000 of proceeds minus the closing costs, and we took those proceeds minus the closing costs and we presented them to the banker who had lent us the money to buy the duplex to pay down the loan. At that point in time, the banker allowed us to transfer the property to the exchanger, and the exchanger assumed the then existing loan on the property, and at the end of the day, the exchange had been completed using the forward exchange methods. Her acquisition or replacement property was acquired within 45 days, within the 45-day time period after the sale of her relinquished property, and she completed an overall successful tax-deferred exchange. The good news is, today we have available to us not only forward tax-deferred exchanges that are safe harbor, we also have available to us statutory reverse exchanges that are also safe harbor so long as the transactions can be completed within 180 days. Many are called, but few are chosen means that you have to have clients that have the financial wherewithal in order to complete this transaction, because in most cases, if they do not have that, they'll not be able to qualify for a reverse exchange. There's one other method of completing a reverse exchange, which we'll just touch on in this video, and that's what we call the classical method of completing tax-deferred exchanges. This is where we are not limited by the 180 days. We actually have no limitations of time whatsoever. Our longest classical is the term that we use. Our longest classical reverse exchange was about 7 years. And this is where we acquire the property prior in time. We operate the property, and we complete the relinquished property closing afterwards and do a normal forward exchange. The difference between the two, in one case, we have 180 days. In another case, we have unlimited time periods. The methodologies of accomplishing both of these are well beyond the scope of a video such as this, but I think at this point we've probably whetted your appetite a bit to understand a little bit more of what goes on in reverse exchange. And this would be a good opportune time for you to take a look at your situation, contact one of our people. We're more than happy on a daily basis to take your phone call, email, fax, whatever it happens to be, and give you specific information as to your particular transaction. Our hope is that you will call us regarding your questions on reverse exchanges, because this is an area of practice that we complete transactions on a daily basis, and we're well accomplished in the area of reverse exchanges. Good day.